So far in 2020, we've seen a lot of volatility in stock markets. The FTSE 100, for example, is down over 20% year to date. The S&P 500 in the US has performed rather better because it's technology heavy and companies like Amazon and Netflix are actually doing pretty well in this environment. This is probably the fastest occurring bear market in history, where we've seen a record decline of 20% in just 16 days for the S&P 500. Typically, when we look at past bear markets, they're divided into three different types: structural, cyclical, and event-driven. So structural is when there are long-term developments in the economy which are negative for economic growth. Cyclical is just a typical downturn at the end of a business cycle. And the event-driven is when something specific happens. Investors are very much viewing this current downturn as event-driven. We've seen a strong rally in equity markets since towards the end of March, and that's because investors are viewing this as a one-off event, i.e. the pandemic will be solved by the end of this year. We are a little bit more cautious than that. We're not sure if there's going to be a second or third wave to this infection, which will continue to impact economic growth. What investors need to be looking out for, in addition to continued stimulation from monetary policy and fiscal policy, is more clarity on how this infection is going to evolve. In particular, we need to see how effective lockdowns have been, how countries can come out of lockdown and stimulate economic activity again, and how a cure to the virus is going to be found. Ideally, we need a vaccine, and there are estimates that a vaccination could take 18 months to 2 years to be delivered globally. Given the market volatility, clearly most funds will have declined in value over the quarter. By way of reference, the FTSE was down over 30% in Q1 2020. Our growth phase fund was down 13%. And for members close to retirement, the declines will be much smaller. But we should focus on the long term. So if we look at our 5-year numbers for the growth phase as of the end of March, the annualized return was nearly 5%. And given the market rally since, returns will continue to be strong. Our funds have performed relatively well because the portfolios are very well diversified. So we don't just invest in the stock market, but we invest across a range of asset classes. This means when markets decline, the volatility in the funds are less. It also gives us the opportunity to use market weakness to rebalance portfolios and buy more shares in particular at cheap levels. The interesting question is what happens after COVID-19? I think this period of lockdown across the world and global supply chains being disrupted will lead to a rethink about how economic activity proceeds. So in the first place, global supply chains and just-in-time delivery manufacturing will clearly need to be re-examined, and companies will need to build up much more inventory so that they are less disrupted if another pandemic strikes. Secondly, around the world, people have been working from home, and companies can see that's been working effectively. So why do they need so much property in centres of big cities? I think companies will start to think about more working from home, and as a result reduce their costs and also reduce their carbon footprint. So if we think about going forward and the need for transition to a low carbon economy, I think there'll be some really interesting lessons learned from this pandemic and how employees and employers have adapted to the circumstances.